Thank you, everyone. Let's now please welcome to the stage our fourth team, representing Central America, Barna Business School.
Good evening, everyone. We are the Barna Business School team from the Dominican Republic. Jose, Maria, Valentina, and William. And we're here to present our analysis and recommendation on Copa Holdings, a commercial aviation provider of passenger and cargo services with main hubs in Panama and Colombia. So let's take off. Through our evaluation, we arrive at a one-year target price of $115.41, offering a 26.06% upside to the closing price of January 4th. This potential upside is based in Copa's strong competitive positioning, favorable industry and macroeconomic dynamics, leading operating metrics, and consistent financial performance.
Now we will fly you through those investment highlights. To better understand CPA's position within the industry, we will explain the segments where they operate. Legacy network carriers with Copa Airlines, a hub-and-spoke model that focuses on underserved markets mainly connected through their main hub in Panama, which has the strategy of being the hub of the Americas. Copa supports this strategy by representing nearly 80% of passenger operations in their international airport. Additionally, they recently jumped in the low-cost playfield with a launch of Wingo in Colombia on December 2016, following the growing industry trend in the Latin American region.
Through our analysis, we found that Copa sustains a very strong competitive positioning among carriers in the region, mainly due to its geographic location and outstanding service focus. Additionally, they pay special attention to customers' loyalty and relationships, evidenced more recently by the launch of their new loyalty program, Connect Miles, which has had an amazing reception in Latin America and has helped Copa strengthen its value proposition. All of this has allowed Copa to achieve at least 50% market share in 45% of the markets where they operate. Additionally, its Panamanian hub allows Copa to offer extensive reach within the continent, so you can easily start your day dancing tango in Argentina and end it listening to some jazz in New Orleans. Always on time, as Copa is the most on-time carrier of the region, according to flight stats, and has one of the most modern fleets, with an average age of 7 years.
Favorable dynamics support our recommendation, as for the last 3 decades, world passenger traffic has doubled every 15 years and is expected to continue this trend in the future. Furthermore, CPA capitalizes on Latin America's economic recovery. Why is this important? Because we have found an existing correlation between the GDP growth and passenger demand. Latin America, which represents 75% of CPA's revenue, is forecasted to grow above 1.6% in 2017. On the other hand, representing the other 25%, North America has raised its GDP growth expectations in the near future. This will allow Copa to perceive a higher demand and less pressure on average ticket charge, which is known in the industry as yield.
Third, as a consequence of a more disciplined capacity growth plan, along with higher aircraft utilization and more low-hour projects, Copa has achieved a strong load factor in the last 4 quarters by placing capacity in the right market. In the third quarter of 2016, they achieved their highest load factor ever of 84%.
Fourth, consistent financial performance. The excluding fuel cost per available seat per mile, CASM in short, has followed a downtrend during the last 8 years, decreasing 14.3%. This is mainly due to lower maintenance costs as a consequence of a modern fleet, lower sales costs and commissions, and lower passenger servicing costs per available seat per mile. This reflects the excellent management decisions taken during the last few years. It would be good to remark that the management team has in average over 15 years experience, as well as 85% of them has experience in major earnings. Now, does the company margins reflect those improvements? Do they generate enough cash to cover their operations, investments, and debt? Oh, talking about debt, Maria, how leveraged is this company?
Well, the 5-year average EBITDA margin is above its peers and competitors with a 23%. This margin also implies their ability to generate enough cash to finance their business operations and expansion, as well as provide cash for equity holders, as we can appreciate in the free cash flow to equity for the next 5 years. Concerning their leverage, by mid-2016, CPA's debt represented 2.8 times their EBITDA. This net debt was adjusted to operating leases in order to give a clear panorama of the situation. Comparing to its closest peers, CPA has lower leverage than Avianca and LATAM, which have multiples of 6.2 and 5.9 respectively. From total financial commitments, 30% correspond to operating leases and 70% to bank loans, financial leases, and lines of credit, from which 60% is fixed. This is very positive under current rates conditions.
Great. After considering each pillar of our investment thesis, we arrive to CPA Holdings valuation, composed by two approaches: a multiple analysis with a 70% weight and a discounted cash flow with the remaining 30%. This led us to a target price of $115.41, representing a 26.06% upside potential. For the DCS, we used the free cash flow to equity. We made a 5-year projections taking into consideration the assumptions of the investment thesis. For the cost of equity, we used the capital asset pricing model, adjusted to a country risk premium of the Latin American countries where Copa Holding operates, resulting in a 13.68% cost of equity. This valuation approach led us to a price of $109.66. For the multiple analysis, we used the enterprise value over EBITDA. Yes, EBITDA, not EBITDA, because in airline industry it's a common practice to use operating leases, such as rentals, as an alternative financing method. The peers were determined based on market cap, small and mid-sized companies, as well as revenue growth. As you can see, Copa has traded at a premium during the last few years. This is basically explained because of the excellent mix between return on investment and revenue growth during the last few years. This valuation approach led us to a price of $117.87. In order to stress our analysis, we perform a 1 million scenario Monte Carlo simulation, stressing the main variables of our investment thesis, such as yield, GDP growth, jet fuel, interest rates, utilization hours, and block hours by available seat per mile. We observe a 68.5% probability of a buy recommendation.
To complete our analysis, we're going to fly you through some of the main risks and mitigants for Copa. We consider the main risk to be a systemic deterioration of Latin American economies, as it can add pressure on yield. Nevertheless, in 2017, a recovery is expected as commodity prices increases and we have less political uncertainty. Protectionist policies in the United States and uncertainty about the immigration reform can cut down spending from the Latin American community. However, Copa is very diversified across the different Latin American countries and has been very proactive in moving capacity from low profitable markets to more potential markets. For example, in 2015, they moved 30% of the total capacity in Brazil to other markets. The other main risk component for Copa is higher jet fuel prices and labor costs. In November 2016, the Organization of Petroleum Exporting Countries, OPEC, agreed to cut the daily output target. Nonetheless, production in non-OPEC countries, especially the United States, are expected to increase due to recent development in productivity of shale fields. Copa hedged approximately 30% of the total jet fuel consumption. Moreover, jet fuel consumption per XM has been decreasing due to the modernization of their fleet. Finally, although labor costs are increasing, Copa has the lowest labor cost per XM among its peers.
In summary, we consider we have identified something the market hasn't priced in yet. We believe Copa Holdings has a very strong competitive positioning, which in hand with its revenue growth potential, favorable industry dynamics, and leading operating metrics will increase its value to investors in the near future. So with a 26.06% upside, we're very confident of our buy recommendation. So we invite you to jump in and make your investment fly with Copa. Thank you very much, and the floor is now open for questions.
Your price, 109.66, I assume that's in U.S. dollars. What is the earnings estimate for this next year?
Well, the earning estimate for the next year, for 2017, is expected to be a dividend per share of 2.5%. The earning per share is expected to be $7.24 per share. And the dividend per share is expected to be 2.89%. We would like to remark there that it's very positive under a peers comparison, and as well as if a company has a dividend yield above the US 10-year bond, it's actually very positive. And they have 2.5, and the bond today was at 2.30.5.
I'm sorry, you said it was 7.24 was the earnings estimate?
7.24 earning per share and 2.89 dividend per share, expecting to be a dividend yield of 2.5 above the US 10-year bond.
What happened in 2015?
Yeah, in 2015, Copa reduced its net income due to two main situations. First, they transparented some non-cash losses with the losses of Venezuela due to currency exchange, and also because of hedging, fuel hedges. When the oil prices went down, they had hedged 30% because it's a strategy. So what they do was transparent those losses. Nevertheless, they still were able to pay dividends that year to their shareholders.
I have a question about their capacity for growth. You showed us that they have a very high market share, that the load factors are already high, and it struck me that the GDP growth that you're expecting in their markets averaging 2%, this doesn't add up to a huge growth opportunity. What am I missing?
Yeah. Well, we have to understand something. In Latin America, Brazil is a big economy, and Brazil's economy went into recession in the last year, and right now it's starting to recover. Copa already moved a lot of capacity from there. But most Latin American economies are growing. For example, 60% of 15% of Copa's revenue comes from Panama, and Panama is growing about 5%. Copa is increasing their frequency in countries like Panama, like Dominican Republic, from where we come from, that is growing above 5%. And also they're growing a lot in the United States. And in terms of capacity, finally, in terms of capacity, they have been very disciplined, and also they're adding capacity without necessarily adding more fleet, because they're using more their aircraft. The aircraft utilization is increasing, and that's good for investment because they can grow capacity without necessarily more CapEx.
The markets that they serve, what does the competition look like? Are there U.S. carriers that are traveling in those spaces, or is it more local?
Yeah, well, Copa's main competitors in the region are Avianca and LATAM. And in the United States, we have other competitors like JetBlue and American are considered competitors according to the regions they serve. But Copa has a very good, strong competitive positioning. What we actually did to prove this assumption was do a fundamental survey with almost 350 Latin American consumers. And what we found was that 65.2% of them are willing to fly with Copa, and they will choose Copa every time they fly in the region. And also, we did a competitive assessment taking into consideration brand reputation and customer satisfaction, and found that Copa has the highest weighted average among North American and Latin American competitors. Their geographic location is a great thing for them too, because it offers them the capacity to attend the entire continent with just one hub. Things that our other competitors have to do with 2 or 3 hubs.
Does Copa still have 2 classes of shares?
Sorry?
Does Copa still have 2 classes of shares?
Yes, they have Class A and Class B. Class A are the only ones listed in the New York Stock Exchange, but they also have Class B shares, which are owned by the group of investors in Panama.
On page 16, your capital asset pricing model, how do you get that valuation? How do you get that number? It's the 10.86.
Sorry, can you repeat again?
How do you get the 10.86 number for your capital asset pricing model on page 16?
Oh, sure. Well, actually, for the capital asset pricing model, we use we adjusted the capital asset pricing model, and this is the most important part. We use the beta of Copa Holdings during the last 52 weeks compared to the S&P 500, and we apply the risk-free rate. And after we adjusted, including the revenue composition and the revenue weight of each of the countries of Latin America, and we use a country premium for those countries. What we used was for Damodaran country premium that he published. We wanted to use the MB difference between the US bond and the bonds of those countries, but that's not totally public. You have to pay for it. And in order to comply with the rules, we used the Damodaran's country premium for each country. We weighted, and we added that adjusted country premium to the CAPM, to the basic CAPM. So it's actually a adjusted CAPM, the 13.68.
So on that slide on page 16, it looks like risk-free rate, beta, and market risk premium, but they don't add up to the capital asset pricing model number, right? I was kind of confused on that.
Let me check. Okay, there you have the risk-free rate, 2.44 at the moment of the valuation, January 4th. That was the risk-free rate. That was the beta. And the market risk premium was 5.69. That is the difference between the risk-free rate and the market risk, which also was taken from Damodaran. That's how we arrived to 10.86.
Those numbers add up to 9.6.
We don't get that.
Can you all talk about, I think we sort of were starting to talk about governance issues with two lines of stock. Can you talk more about the governance of this organization?
Yes, the corporate governance. There are 12 members of the board of directors, of which 63% are related. But we did a corporate governance assessment, and actually the result was that they are focused on long-term growth opportunities, and they also have an independent relationship with the executive officers, allowing for objectiveness with the decision-making, the creating value for stockholders, and the expansion of the business. We can see this with the stock performance since they became an IPO. The price was $20. And at the moment of our valuation on January 4th, it was $91.55, which is actually a 400% increase from their price.
And do you have any concerns about the two classes of stock?
Actually, we thought about it, but after the assessment, we consider that it's actually not a threat because they are very focused on the long-term growth of the airline, of the industry, well, the airline, because it's actually a family legacy. So they just wanted to keep growing, and they also are very confident of their executive members, of their management. So they actually let them decide what's best for the company.
Thank you.
They own or have long-term leases on many of the gates at the airports, or are they getting them from the other airlines?
Well, their main airport is Tocumen. Actually, they've invested with the government a lot of money there, and that's where most of their flights connect through. For international airports, they have a lot of slots in their main markets because, as we mentioned earlier, they have at least 50% market share. So they have priority, and that allows them to offer extensive connectivity through the region and flexibility with the schedules.
What's their break-even price for jet fuel costs? At what point would they start hurting financially?
Well, what we did was we stressed the jet fuel cost, and we understand in the analysis with the tornado analysis that if jet fuel prices increase $10 per barrel every year, our recommendation will convert into a whole because they're not going to be able to sustain the return on investment.
Do they have a currency hedging program in place as well, or just fuel?
45% of their income is in US dollars, and what they do with the countries where they have a currency risk is actually sell in US dollars or convert very quickly. So that's how they mitigate currency risk.
On your analysis of the multiple analysis and then the discounted free cash flow analysis, you applied a 70-30 weight to those. Can you talk about how you made that decision?
Well, the common practice in the industry is to use the enterprise value over EBITDA for airline industry.